As we continue talking about profitability and some basic measures or metrics of performance, let's start with operating profit, or the operating profitability ratio. This is net operating profit after taxes divided by sales, a performance measure for how much is left over from the sales after we consider the cost of operations. I look at this as a measure of control. How well does management control the expenses of the company? This number for Molson Coors has moved around. Of course, in this time frame, we did have COVID to deal with. But we might also look at this if we kind of ignore the COVID aspect and say, well, we see that there is some growth, right? 7.14, now it's 10.37. So there is growth over 5 years. However, there's a lot of variability. So what this tells me is either revenues are very unstable and or our control of expenses are very unstable. And of course, with COVID in there, that helps us answer the questions for those couple of years that we've seen have these big swings in profitability. The capital requirement ratio basically tells me how much assets do we need to perform the operations of the business. We'd like this number to be as small as possible, right? We want to create lots of sales using the least amount of capital as possible. So these numbers can mean, lower numbers can mean that the company is very efficient. So even though we see some decline, and it's a fairly substantial decline, the total change is really only about 5%. So the picture looks pretty dramatic, but really 5% change over 5 years is probably a decent number, right? A decent change over time. So a big number, if we had a big number itself, that would tell us that maybe the company needs too much assets or we're not using them efficiently. So again, this picture here shows that management is moving in the right direction. We're using our assets fairly efficiently to generate the sales of the company. The return on investment capital combines this net operating profit after taxes with the total operating capital, right? What return are we getting for the assets that we have purchased? As you can see here, I have a number here for ROIC, return on invested capital. We looked up on Google, and I found that Coors today is their weighted average cost of capital is 5.26%, where 5.26% is the benchmark for profitability. That's the cost of financing our operations on average. So ROIC measures, again, how efficiently the company uses its capital to generate returns. It's compared against this weighted average cost of capital. If ROIC exceeds the weighted average cost of capital, the company is creating value. So Molson Coors, for example, aims for an ROIC greater than its weighted average cost of capital of 5.26%. High growth companies such as Tesla often have negative free cash flow due to large investments. But as long as their ROIC is greater than their weighted average cash flows, they are on their path to creating some long-term value for the firm. As you can see here, most years are positive, but we do have an upward trend of ROIC. And the last, at least we had 2 years in here that had an ROIC greater than the weighted average cost of capital. Economic value added and market value added are additional performance measures, if you will. Market value added, you take the market value of the equity of the stock, that is the number of shares times the price, and you subtract from that the book value of the firm. So this is essentially the common equity of the firm, total assets minus total liabilities. We have the weighted average cost of capital again for the company we found is 5.26%. The economic value added is the NOPAT, net operating profit after taxes, minus the weighted average cost of capital, times the capital. So what we find here, let's start with market value. Excuse me. Economic value added represents the profit generated above the cost of capital, while market value added reflects the difference between the market value and the book value of equity. Companies with high EVA, like Alphabet, Google, generate significant profits above their cost of capital, which is a strong indicator of operational efficiency. So positive EVA suggests or signals effective management and value creation for shareholders. When we look at Molson Coors, we find some challenges. Number one, their market value added is negative, which means they do not have a market value greater than their accounting value. This is very important for investors. In addition, EVA, as you notice, has out of the 5 years, there were only 2 years with profit. Again, this involves a whole time frame here with COVID. However, these numbers are very important and may have a great concern, not just for investors, but certainly for managers who would be interested in these numbers. Our hope is that as we analyze the financial statements of the company, we can develop some understanding as to why this is happening. Let's talk a little bit about taxation. So there was a first major rewrite since 1986 happened in 2017. What are the essentials? Number one, the 21% flat rate on taxes. This replaced any of our progressive rates that we had historically, and certainly of note is it replaced the 35% top marginal rate, which is where most large corporations were. So in general, corporations pay 21% taxable income on everything, pre-tax profits from all operating activities, from the sales and products to customers, services provided, the capital gains on all of the investments in equipment and securities that the company no longer needs. So again, taxes are all based on the same rate. We'll assume that the potential for state and local taxes is there, so that we'll use an average tax rate of 25%. What happens if a company has negative profits? So a company can carry forward negative profits into the future. The cumulative past operating losses, we can use up to 80% of that against current income. Any unused piece of cumulative past losses, we can move those forward to offset future profits, however, at this maximum of only 80% of current taxable income. So prior to this tax code, you can carry forward losses forward for only 20 years, but you can carry them back to get a refund. So this provision helps smooth out a company's tax burden over time. Airlines such as Delta used net operating loss carry forwards after the pandemic to reduce taxable income as their operations returned to profitability, providing much needed relief during their recovery. The challenge for me is that this historically, this made rather unstable cash flows to the government, because if you carried it backwards, if you paid taxes last year and carried it backwards, you would be asking for a refund. So moving forward, there should be no tax refunds for corporations. So how does this work? So let's assume that in the past we've accumulated a total of 72 billion in net operating losses. This year's taxable income is 80 billion. How much can we deduct from this year's taxes? The limit is 80%. 80% of 80, 64 billion. Our tax rate's 25%. So our taxable income would be the 80 billion taxable income minus the 64 billion write-off. So now we have profits of 16 billion. Multiply that by 25%. That tells us then that we have $4 billion in taxes. Again, big companies, all companies, quite frankly, should always be paying taxes. We shouldn't get to a point now where companies will be able to, large companies would be able to have negative taxable income and not pay taxes. Interest and dividend income that's received by the corporation, again, taxed at 21%. However, dividend, they get to exclude 50% of the taxable of the dividends from other companies. This helps to eliminate essentially what we refer to as double taxation. So it's not really a benefit for the corporation. It is to limit how much taxes the owners of the company ultimately pay. What about dividends paid and interest expenses? Dividend payments to shareholders are not deductible as expenses. They come out after net income. But interest expenses have a new rule, right? We can deduct interest expenses from our operating profits, EBIT, but we can only to a limit of 30% of EBIT. Again, what I think this does is it forces companies to monitor their interest expense, because every year they may not be able to deduct its entire liability as far as interest expense. Now, they can carry this forward, but they can't carry it backwards. So in addition, EBIT will almost always be profitable. You have to make money in the operations of the firm. But if it's profitable, that also means earnings before taxes has to be profitable, because interest can only be 30% of that. And again, here's our overall example here. Company has 50 billion in EBIT and 20 billion in interest. So the maximum interest deduction this year is 30% of the 50 billion EBIT, or 15 billion. So earnings before taxes would be 50 billion minus 15. So they'd have 35 billion in taxable income. So the remaining unused interest, 5 billion, they would carry that forward and deduct it against future years. Corporate gains arise when companies sell an asset for more than it paid for the asset, or for more than its book value. And capital losses are the opposite. Capital gains and losses are treated just like any other income. They're taxed at 21%. What do we do with foreign profits? Foreign profits earned by overseas subsidiaries are taxed at the subsidiary's legal residence. For instance, if I had a subsidiary that was based in Ireland, I would put it there. The reason it's there, they have favorable tax laws. So the tax that we pay is to Ireland, not to the United States. And prior to this, there were no U.S. taxes due if you reinvested overseas. However, taxes were due if any of the profits were returned to the parent. So this change in how foreign taxes were paid and um, um, how cash flows came back to the states is different, right? So this removed the tax on returned capital to the United States. At one time, Apple had billions of dollars overseas because the tax was so high. When this law changed, they brought the cash back and they expanded their operations. Thanks for listening to this video. See you the next time.